Looking for strategies to help you protect your portfolio in these uncertain times? Visit robblack.com. robblack.com, powered by EP Wealth.
This is the Rob Black Show. The ceasefire news this week brought equities back to where they were when the war sent prices into a nosedive. We're about 2% from all-time highs at one point this week. If we had predicted that 5 weeks ago, you would have taken those results. Because typically these strikes in Iran or the Middle East tend to last maybe 10 days. Now we're into 5 weeks. All the other themes that we were worried about before the war crept back in. Now, the war pushed oil up to $110 a barrel, so inflation became an issue. We thought inflation was basically dying slowly, and that the Federal Reserve was going to be able to lower rates 2 to 3 times this year. At one point this week, we thought, nope, they may raise interest rates. And then we got some data that said, no, they actually may cut rates. A lot going on. This week, we got worried again about the software as a service apocalypse. It's back. Software companies like Adobe, Intuit, and others are getting hit. There's questions about the overall spend in AI, questions about tariffs, macro woes. It's a whole new market this week versus last week. Wartime data is starting to arrive, and we've had a messed up data system because of government shutdowns, sometimes pushing data back as much as a month. We're going to start seeing May and June, as now we're starting to see what's going on with the 50% jump in oil. This week in the United States, and Iranian officials are meeting in Pakistan to discuss their positions and hopefully work towards an agreement that turns the temporary ceasefire into a permanent one. And yet the two parties seem far apart. So the market has its reservations about such an outcome. The trading action so far this week has been grounded in hope that the worst of the conflict is past. The main source of anxiety is what lingering effects this war will have on the global economy. You're starting to see European countries' leaders not freak out, but really yell at Donald Trump's administration for how they're pushing energy prices up. And they feel victimized because they have nothing to do with Putin and Ukraine, and they have nothing to do with Iran and the United States. So the big determination this weekend will revolve around when safe passage to the Strait of Hormuz is restored. Reports indicate that traffic is still largely at a standstill. Today, in a Truth Social post, Trump warned Iran better stop charging tolls and added that it's doing a very poor job of allowing oil to go through the Strait of Hormuz. But oil prices have settled down this week. Crude's around $97 a barrel, 95 to 97, depending on the time of the day. Total CPI came out this week. Today, it was up 0.9% month over month in March, following a 0.3% increase in February. Core CPI, which excludes food and energy, was up 0.2% month over month. These numbers weren't as bad as feared. And yet we saw airfares skyrocket as carriers are tackling rising fuel costs. Airfares jumped in the month of March as surging jet fuel prices quickly filtered through to consumers. Airfares skyrocketed 14.9% in March. Ouch. It isn't the only cost increase travelers will face in the months ahead. Major airlines have hiked bag fees in recent days this week in a bid to mitigate rising fuel expenses. There's fuel charges for international flights. Some of the airlines are canceling the low-cost times, like 6 in the morning or 9 p.m., pushing more people into the prime time flights that cost more. The U.S. airline industry could face an annual fuel cost headwind of about $40 billion, Deutsche Bank analysts warned late last week. So that was before the U.S.-Iran ceasefire was agreed. Delta is the premium name in the industry if you wanted to make a bet. I'm not a big airline guy because I see them as big buses in the sky. But they're going to have record quarters. Second quarter, third quarter, fourth quarter, because they've raised bag fees, because they've increased fuel charges, because they've cut the cheaper flights for you out, forcing you into more premium time slots. It's going to be a bonanza year for the airlines if this ends soon. The NASDAQ is set to exit correction territory as the AI rally resurfaced this week. The NASDAQ was trading 10% higher than its lowest close since entering a correction on March 26. When a stock closes 10% from its recent closing high, In the NASDAQ's case, it's October record to close. It falls into a correction. It then needs a rally of 10% from its lowest close in correction to exit. A 20% fall from a recent high is known as a bear market, which requires a similar 20% rally from a recent low orbit. If the NASDAQ pulls off an escape and closes higher today from the correction, it would mark its shortest correction since October of 2011. It's on track for an 8-day winning streak. Now, something else happened this week that I want you to be very, very aware of. Because when the war is over, we're going to start thinking about earnings season. If, for instance, it ends in the next 2 weeks, we're going to look at earnings season because we're moving into earnings season. And the AI trades are very profitable. Not all of them. Stock markets are getting hopes that the conflict will come to a resolution over the coming weeks. There aren't many of those bigger than the billions being committed to artificial intelligence on the investment boom that are concerned right now. They've arguably been the single most important driver of U.S. stocks over the last 3.5 years. Bank of America estimates the biggest AI hyperscaler spent $166 billion over the 3 months ending in March, a 13% increase from last year. That points to a $750 billion tally for this year and a staggering $872 billion total for 2027. Meta unveiled its first new AI model this week, known as Muse Spark, from the Superintelligence Lab. It created to supplant failure of its metaverse project. It inked a $21 billion compute power deal with CoreWeave, taking its contract total to $35 billion as it continues to ramp up spending on AI infrastructure. Oracle, meanwhile, has poached a well-regarded executive from Schneider Electric named Hilary Maxson to serve as its built-for CapEx finance chief, which has the task of driving efficient approaches to allocating capital, delivering capacity, while producing profitable recurring revenue for the cloud infrastructure team. Anthropic is making headlines everywhere, and they're helping to pick the winners in AI right now. They have an AI compute deal with CoreWeave, worth billions. Bloomberg reported that OpenAI pitched investors on its competitive advantage over the Claude developer due to having secured more computing power. If you buy into that idea that compute equals revenue, which is what NVIDIA CEO Jensen Huang has recently argued, that gap matters, and it means Anthropic has some work to do to catch up. Hence the pact with CoreWeave, which is further enhancing demand for compute and AI accelerators. Bank of America's Arya thinks the return on investment might be sooner than later. Google and Broadcom earlier this week said that they see access to 3.5 gigawatts of TPU-based AI compute capacity beginning in 2027. CapEx is an upfront investment for future token generation abilities. What does future token generation abilities mean? It means revenue in the AI world, and free cash flow margins could recover back to 5 to 10% levels over the next few years as the return on investment improves with the new second-generation AI applications, such as the agentic interface OpenClaw. A lot happened this week. The AI trade woke back up. The Magnificent Seven tech giants has risen more than 9.8% since the March 30th low, well ahead of the S&P 500's 7% gain during the same period of time. Investors are waiting for it. They're waiting for the war to end so they can get back into the AI trade before earnings season. It looks pretty clear to me. Valuations have come down to the point that some AI trades, like NVIDIA, Meta, Microsoft, trade at below market values compared to the S&P 500 on comparables. It's wild to see. Don't forget, I've got a big show coming up for you today. On top of that, I have a Pints and Portfolio coming up. It's going to be in Sunnyvale, California, so I probably won't be back for about 9 months in that area. Saturday, April 18th, 11:30 to 1:30. Learn more information during the commercials or go to robblackshow.com and sign up today.
Join Rob Black in Sunnyvale Saturday, April 18th for Pints and Portfolios, a less formal event at a local watering hole for those close to retirement with $500K or more in investable assets. Drop by from 11:30 to 2 for a little sunshine and a complimentary preliminary financial plan from a CFP that Rob trusts at EP Wealth Advisors. Whether you're on the road to retirement or already there, this preliminary plan can provide you with a second opinion analysis of where you are and highlight areas for improvement and opportunities for growth. That's Saturday, April 18th in Sunnyvale. Go to robblackshow.com and click the Events tab. Find Pints and Portfolios and click to register. You'll answer a few simple questions about your situation, and your confirmation email will provide all the details on the location of this Sunnyvale event and how to schedule your preliminary financial plan. Space is limited and registration is required, so go to robblackshow.com today. That's robblackshow.com. Investments not FDIC insured. Past performance does not guarantee future results. Not an offer to sell or a solicitation to buy any security. Member FINRA SIPC.
Meta certainly had an interesting week.
I am proud to announce that starting today, our company is now Meta.
They unveiled a new AI model. It's first from the Superintelligence Lab. It's being well received. There's going to be different winners in AI. I want to talk about the post-phone era because that's one of Meta's big bets, especially integrating AI into it. Why your face is the new real estate. Let's be honest, the smartphone has peaked. We've reached the plateau of the rectangle. Every year, the cameras get slightly better, the screens get slightly brighter, but the form factor really hasn't changed since 2007. Enter the year 2026. We just saw smart glass shipments quadrupled 8.7 million units from the prior year. That isn't just a gadget trend. That's the sound of a new computing platform being born. Mark Zuckerberg, he sees it, that eventually we won't be looking down at a screen on our palms. We'll be looking through a lens at the world augmented by AI. I'm going to tell you some speculative investments here. Stick with me, okay? Qualcomm put it perfectly, saying these things see what you see and hear what you hear. It's the agentic AI experience. It's like having a digital assistant sitting on your nose, ready to whisper the name of the person walking toward you or translate a menu in real time. There's going to be massive privacy issues and battery issues if it's noticing everyone coming at you. Right now, Meta has the dominance. Meta is the 800-pound gorilla in glasses. They own over 85% of the market share. Their partnership with Ray-Ban. These aren't just selling tech, they're selling style, which was the missing ingredient back when Google Glass failed in 2015. But it's not all clear skies ahead. There's going to be a privacy hurdle. Meta and EssilorLuxottica are currently staring down a potential class action lawsuit. The allegation is the video data is being routed to contractors for AI training. Meta insists media stays on the device unless you choose to share it. Now, whether these concerns slow down adoption remains to be seen, but for now, the momentum is massive. Shipments are expected to be 15 million units this year. Let's talk about the picks and shovel strategy, because that's working really well in AI right now. Everyone is watching Meta and Apple, but smart glasses are a tiny fraction of their revenue. For Meta's Reality Labs, the $2.2 billion that they brought in last year is essentially a rounding error on their balance sheet. If you want to play the trend, don't look at the titans, look at the suppliers and the retailers. These are the companies where smart glasses aren't just a cool project. They're a bottom line needle mover. Let's talk about the gatekeepers. I refer to them as retail and distribution. Warby Parker is the cool kid on the optical world. They've hitched their wagon to Alphabet. Google's got a $75 million investment. Analysts think Warby could grab double its usual market share in the smartphone glasses space. Currently trading around $21 with a $25 target. You're looking at a potential 700,000 to 4 million pairs sold by 2030. Then there's a retail player called National Vision Holdings, ticker symbol EYE. National Vision is a powerhouse. If Warby is a boutique, they're rolling out Meta glasses to every single store by the end of second quarter 2026. That's right now. By 2030, smart glasses could account for 10% of their total sales, trading near $24 a share. The stock has more than doubled in the past year as it pivots towards premium smart products. Ticker symbol is I on National Vision Holdings. Qualcomm is essentially the Intel of the wearable world. They're the merchant supplier for Meta's hardware. They're aiming for $2 billion in revenue from extended reality by 2029. Currently trading at $125. Then you also get into Global Foundries, ticker symbol GFS. Qualcomm is the brain. Global Foundries makes the parts that handle the displays and radio signals. Currently trading around $43, they're positioned themselves to be the dominant foundry for this category, which they estimate as a $1 billion opportunity. Now, I'm going to get into some speculative names, and please take this as a grain of salt, or do your own homework. I think both of them are very interesting, and I've done a lot of research. Smart glasses have a major problem. You can't fit a massive iPhone battery into a pair of Wayfarers. So Innovix, ticker symbol ENVX. This is a specialist in high energy density batteries. The stock has massive volatility, recently trading around $6. $6. It's a small cap. It's a micro cap. To make glass thin and light, you need silicon anode batteries. Innovix offers the opportunity for leadership in this nascent market. TD Cowen lowered their price target from $15 to $7.50. It's currently around $6. So $6 to $7.50. Once price target of $15 tells you that people see opportunity. It's just slow to realize. Analyst Jeff Osborne said smartphone qualification experienced delays due to misaligned cycle life testing, pushing meaningful revenue to the right. On Innovix, posted a record quarterly revenue with margin expansion. That's a good thing. That's two good things. You need 5 before you buy. Smart eyewear and defense programs are emerging as near-term opportunities ahead of the broader 2026 ramp. They see it at 7 times sales, which is crazy for a developing company, given reduced visibility into the handset market. If you play a name like this, you buy 1% of your portfolio, and it might grow into 5. It might. This is like Quantum a year ago when I was telling you about that, and those stocks doubled and tripled. The next one that I want you to take a look at is the intellectual property play. Sometimes the best way to win isn't by selling the product, but by owning the idea of the product. There's a company called Vuzix Corporation, ticker symbol VUZI. This is a speculative wild card, trading at $2.51 with market cap of about $200 million. Their sales are small, but their patent portfolio is huge. No matter what goes on in Iran, isn't going to affect them because they're playing smart glasses that Meta and Apple are developing. They have over 450 patents. They are the royalty layer play. As big tech enters the space, they may end up paying Vuzix to keep their glasses on people's faces. Vuzix Corporation is expanding its reach into the global veterinary medical market through a reseller program with Mavora. Now, veterinary? A global veterinary medtech company specializing in orthopedic implants, surgical instruments, and continuing education for veterinary professionals. Mavora plans to distribute the Vuzix M400 smart glasses-based remote support kits through their customer growth initiatives to a North American network of veterinary professionals. Vuzix is into augmented reality hardware. Its product revenue is negligible by big tech standards, and it has a market cap of just $200 million. It claims over 450 patents, like I mentioned. Augmented reality could end up looking like a lot like the royalty layer in smartphones, where a small set of IP owners extract value from a much larger hardware ecosystem. The long game here is, are smart glasses going to replace the phone tomorrow? No. But look at the trajectory. Phase 1 was audio-only or basic camera glasses with Meta Ray-Bans. Phase 2, glasses with heads-up displays will be notifications on the lens. Phase 3, full augmented reality where the digital and physical worlds merge. By the time we hit Phase 3, these suppliers won't just be benefiting. They'll be the backbone of a new trillion-dollar ecosystem. How do you position yourself? Stability, you go after Qualcomm or EssilorLuxottica. Growth in retail, you go after National Vision, ticker symbol I, or Warby Parker, ticker symbol WRBY. Speculative, it's Innovix, ENVX, or Vuzix, ticker symbol VUZI. The shift from niche to mainstream is happening. Picking the winning pair of glasses is a coin flip, but backing the suppliers and retailers, that's the smart way to play the revolution. I don't know if glasses are going to be the hit. With that said, a lot of people think smart glasses are coming. They're still not at 100 million units, so there's a lot of questions. You can always find me online at robblackshow.com. That's robblackshow.com. Don't forget I have an event coming up Saturday, April 18th. That's less than a week away, 11:30 to 1:30, Sunnyvale, California. It's a good chance for you to sit down with me and 2 CFPs. Julie and Ryan will be in the South Bay, Sunnyvale, California. Saturday, April 18th, 11:30 to 1:30. I'll buy the beers. It's informal, and you get a free portfolio review as well as a preliminary plan after the event. Sign up at robblackshow.com.
You are listening to the Rob Black Show podcast. For more information on EP Wealth, visit robblack.com. That's robblack.com.
Amazon stock has had quite a week. You might remember back at the start of the year, I called it my favorite stock of the year. It was actually one of 2 favorites. It's been an interesting year. For the week, the stock's up 13%, moving from 210 level to 240, all-time high around 255. My price target, if things go well in the stock market this year and the Iran situation settles down, 360 to 400. From a small online bookstore in 1994 to a global infrastructure titan, Amazon's history is a masterclass in day one thinking, the philosophy that a company must act like a hungry startup to avoid stagnation. Wait till you hear what happened this week. While the world first knew of Amazon for its disruptive impact on retail and delivery logistics, the company has undergone a profound metamorphosis, and we saw a lot of it this week. It's no longer just a store. It is the invisible backbone of the modern economy, evolving from delivering packages to managing human health, and now increasingly designing the very silicon that powers the artificial intelligence revolution. Amazon's first major evolution was mastering the physical world. What began as the pursuit of Earth's biggest selection forced the company to build a logistics network that rivals national postal services. By perfecting the last mile of delivery, Amazon didn't just sell products, it sold convenience and speed. The obsession with efficiency created a massive internal demand for data and computing power, which accidentally birthed their next great pillar, the Amazon Web Services revolution. In the early 2000s, Amazon realized that the robust internal systems it built to handle holiday shopping surges could be rented to others. This became Amazon Web Services. It was a pivot that changed the tech world forever, moving computing from a capital-heavy hardware investment to a utility-like service. Today, Amazon Web Services is the company's primary profit engine, providing the financial oxygen that allows Amazon to experiment in entirely new sectors. Amazon's expansion into healthcare through acquisitions like One Medical and the launch of Amazon Pharmacy represents its attempt to apply its flywheel effect to its fragmented, high-cost industry. In fact, I switched my pharmacy from CVS, which is local, to Amazon because I own shares of Amazon, and I like to put my money where my mouth is. I'm not sure what that means, but it's true. By integrating primary care with its logistic prowess, Amazon is attempting to make health services as frictionless as ordering a book, and it's a pretty good deal for some people without insurance. It's a move, ultimately, that leverages their massive Prime subscriber base to create a vertically integrated health ecosystem. Amazon's healthcare expansion is a multi-layered strategy. By combining its 2023 acquisition of One Medical with aggressive AI integration and logistics, Amazon is targeting three major areas: primary care, pharmacy delivery, and chronic disease management. The Amazon One Medical brand offers a hybrid model of in-person and 24/7 virtual care. Prime members can join One Medical for $9 per month or $99 a year, granting them 24/7 on-demand virtual care and easy booking at physical clinics nationwide. For non-members, Amazon rebranded its clinic service the Amazon One Medical Pay Per Visit, which offers upfront fixed pricing starting at $29 for over 30 common conditions like hair loss, skin care, and allergies. This week, we learned more about Amazon's Starlink competitor, Leo. It's getting a new date. Amazon CEO Andy Jassy talked a lot this week, including a letter to shareholder investors. I meant to say investor shareholders. He talked about the space internet service called Leo. It was formerly known as Project Kuiper. It's going to launch in the mid-2026. So that's an event when it launches. We'll be talking about it on this show. It may or not hit mid-2026, but when we do, people are going to be like, wait, they do phone service? They do internet service? They do video into plane service? Unlike SpaceX Starlink service, Amazon doesn't yet have its own fleet of rockets to regularly send LEO satellites into low Earth orbit. That means hitch and rides with the partners, including SpaceX, until Jeff Bezos' own reusable New Glenn rocket is fully operational. Amazon has FCC approval for 3,236 LEO satellites, but it's only launched 241 so far. That's well below its commitment to have half, 1,618 of them in constellation deployed by July 2026. Amazon has had to beg the FCC chairman, Brendan Carr, for an extension. For comparison, SpaceX active Starlink constellation currently has 10,000 satellites. But Andy Jassy said, when LEO service does finally go live, it'll be faster than existing services and cost less, with the added benefit of integrating seamlessly with Amazon Web Services so that the businesses and governments can move data back and forth for storage, analytics, and AI. Late as it is, there are many individuals, enterprises, and nations just waiting for an Elon Musk alternative that can be installed quickly and economically to fill gaps in global data coverage, even if it does mean casting their lot with another problematic billionaire. This is going to lead to an Amazon phone, and it's going to further cement Amazon Prime into homes and into planes and all around the world. Amazon's $200 billion AI bet on Amazon Web Services, it isn't a risk. It may be the reason stock soars. Investors are growing uneasy about Amazon's aggressive push into artificial intelligence, but this week was a turning point where they started to reward them. When you compared Amazon's PE, which is about 25, with Walmart's PE, which is about 45, Walmart is a big retailer of chips, like Doritos. But Amazon said this week, we're going to be getting into chips like NVIDIA semiconductors. And they also sell chips that they'll deliver. That level of investment, $200 billion into AI-related capital expenditures, is raising familiar concern on Wall Street. I think it's an opportunity. BNP Paribas analyst Nick Jones said Amazon's AI spending should not be viewed as speculative or excessive. Instead, it reflects a company racing to keep up with accelerating demand, particularly within its cloud division, Amazon Web Services. The key issue isn't weak demand, it's constrained supply. As businesses rapidly adopt artificial intelligence tools, from training large models to deploying real-time inference, the need for computing power has surged. That includes GPUs, storage, and network infrastructure, all of which Amazon Web Services provides. In that context, Amazon's massive capital expenditures are less about taking risks and more about expanding capacity to meet demand that's already visible. CEO Andy Jassy dismissed fears of an artificial intelligence bubble, and he told investors they shouldn't expect any slowdown in the firm's AI investments. Jassy says he has the figures to back it up. He said, "I followed the public debate on whether this technology is overhyped, whether we're in a bubble, and if the margins and return on invested capital will be appealing." His answer was, "My strong conviction, at least for now, is that the answers are no, no, and yes." So what's that mean is, are we in a bubble? No. If the margins and return on investment capital will be appealing is yes. And is the tech overhyped? No. Amazon has projected capital expenditures of around $200 billion this year, largely on AI data centers. That outstrips even the spending of other companies like Microsoft or Google parent Alphabet. Jassy argued that the revenue is already flooding in, pointing to Amazon Web Services, the company's cloud unit, having an AI revenue run rate of more than $15 billion in the first quarter of this year alone. This is stunning numbers. One of the most important indicators supporting this view on Amazon's backlog to CapEx signal is the ratio, backlog to CapEx ratio. Amazon Web Services maintains a substantial backlog of contracted future revenue, giving the company clear visibility into demand that many investors may realize. The backlog suggests Amazon is not building blindly, it is investing against business that is already in the pipeline. In practical terms, that means the billions being spent on AI infrastructure today are likely to be monetized over time as customers ramp up usage. This isn't the first time Amazon has faced skepticism over heavy infrastructure spending. In the early days of cloud computing, the company invested aggressively in Amazon Web Services capacity, drawing criticism for its impact on near-term profitability. But as demand surged, Amazon Web Services became one of the most profitable segments in tech and a cornerstone of Amazon's valuation. The current AI cycle may follow a similar trajectory. What looks like margin pressure today will ultimately translate into a powerful earnings engine as utilization increases and fixed costs are leveraged. The case for upside would be that AI demand continues to accelerate. Amazon Web Services converts its backlog into revenue. New infrastructure drives higher utilization, and margins expand once that build-out phase stabilizes. Now again, this is only Amazon Web Services that we're talking about. Shares could rise 50%, as much as 50% from current levels if this year goes well on AWS. Now, Amazon is no longer just a cloud provider that uses other people's hardware. It is rapidly becoming a semiconductors powerhouse in a move that directly challenges the dominance of NVIDIA and Broadcom. CEO Andy Jassy recently revealed that Amazon's in-house chips business is on track to generate over $20 billion in annual revenue, with the potential to hit $50 billion if it sold its processors broadly to third parties. The shift transforms Amazon from a top customer of chip giants into a formidable competitor in the AI infrastructure space. Think of them as becoming a baby NVIDIA or a baby Broadcom. Virtually all of AI thus far has been done on NVIDIA chips, so said Andy Jassy. But a new shift has started. We have a strong partnership with NVIDIA. We'll have customers that want to run NVIDIA, and we'll continue to make Amazon Web Services the best place to run NVIDIA. But some customers want better priced performance. He compared the shift to Amazon eating into Intel's dominance in the CPU space with its own chip that launched in 2018 called Graviton. The same story arc is unfolding in AI. Amazon's latest chip, the Trainium 3, is 30 to 40% more price performance than in previous models, so says Andy Jassy. Amazon's AI spending may look excessive at first glance, but a deeper look suggests it's tightly linked to real growing demand, particularly within Amazon Web Services. If that demand continues to materialize, today's heavy investments into semiconductors, Amazon Web Services infrastructure, healthcare, and much, much more, it's not going to be a liability. It's going to be a mere foundation of the company's next phase of growth. I have a Pints and Portfolio coming up Saturday, April 18th, 11:30 to 1:30 in Sunnyvale, California. It's for financial planning questions. How are you doing? Where are you in retirement? What are you doing right? Sign up today at robblackshow.com.
Join Rob Black in Sunnyvale Saturday, April 18th for Pints and Portfolios, a less formal event at a local watering hole for those close to retirement with $500K or more in investable assets. Drop by from 11:30 to 2 for a little sunshine and a complimentary preliminary financial plan from a CFP that Rob trusts at EP Wealth Advisors. Whether you're on the road to retirement or already there, this preliminary plan can provide you with a second opinion analysis of where you are and highlight areas for improvement and opportunities for growth. That's Saturday, April 18th in Sunnyvale. Go to robblackshow.com and click the Events tab. Find Pints and Portfolios and click to register. You'll answer a few simple questions about your situation, and your confirmation email will provide all the details on the location of this Sunnyvale event and how to schedule your preliminary financial plan. Space is limited and registration is required, so go to robblackshow.com today. That's robblackshow.com. Investments not FDIC insured. Past performance does not guarantee future results. Not an offer to sell or a solicitation to buy any security. Member FINRA SIPC.
The biggest threats to wealth typically aren't in the stock market. It's the quiet risk that can derail even the best financial plan. Financial planning conversations tend to orbit around markets, what stocks to buy, how to allocate assets, when to rebalance. Advisors build sophisticated portfolios designed to weather volatility, minimize costs, and capture long-term gain. But here's the uncomfortable truth. For many investors, the greatest threats to wealth aren't market crashes or bad investment picks. They're life events. They're blind spots. Decisions deferred too long, risk hiding in plain sight. Divorce, longevity, taxes, and estate planning failures. These are not flashy risks. They're not fun. They don't show up on a ticker, but they can quietly erode or outright destroy decades of disciplined investing. I've seen it happen numerous times to other people who have asked me for help. Increasingly, advisors are realizing that protecting wealth requires just as much focus on these non-market risks as it does on portfolio construction. Divorce is the financial earthquake few truly plan for. Divorce is often treated as a legal event. In reality, it's one of the most complex financial restructurings a household will ever experience. Assets are split, income streams change, tax profiles shift, retirement assumptions are reset, and in many cases, the lifestyle that was supported by one household now must be supported by two. The math alone is unforgiving. A couple living comfortably on $250,000 a year may find that post-divorce, neither individual can maintain that lifestyle independently. Housing costs double, insurance costs rise, investment strategies must be recalibrated. The spouse stepping into financial leadership midstream is forced to make high-stakes decisions without years of accumulated context. That's a vulnerability. There's the emotional overlay as well. Divorce is rarely a purely rational process. Decisions are often driven by urgency, stress, or desire just to be done. Divorce planning shouldn't begin at separation. It should be embedded into financial literacy and shared decision-making before it becomes a possibility. EP Wealth has divorce specialists for when this happens to wealthy couples. Longevity is another big issue. Living longer, it can be the surprise hit. That's a good problem to have, but financially it introduces a level of uncertainty that most plans underestimate. Retirement used to last 10 to 15 years. Now it can last 25 to 35 years. That dramatically increases the risk of outliving your savings, facing extended periods of market volatility, encountering large, unpredictable healthcare costs, and increasingly, retirees just aren't supporting themselves. They're supporting others on both ends of the generational spectrum. Aging parents may require long-term care, assisted living, or in-home support. That's $100,000+ a year. At the same time, adult children may be still financially dependent, whether due to student debt, housing costs, delayed career stability, or even that divorce that we were just talking about. This creates what's often called a sandwich generation effect. Financial pressure from above, your spouse that's aging into long-term care, and financial pressure from below, your children who haven't quite hit their success financially. A lot of people forget about medical costs in retirement. They're expensive. Extended care is the obvious one. It's going to cost you $100,000 annually, and that's at today's prices. Think about the future. People assume they'll remain healthy, they won't need extensive care, that family will step in if needed. Longevity risk isn't just about living longer, it's about funding a larger, longer period of time that's more complex with a web of dependencies and uncertainties. The estate planning mistake that people overlook as a challenge or a pothole in retirement can derail your finances. Many people treat estate planning as a one-and-done exercise. It's a mistake. They draft a will. In California, you should draft a trust. Check that box. Move on. That's what I see a lot of people do. But estate planning is not a document. It's a process. The biggest risks often emerge not in the creation of the plan, but in its execution. A well-drafted trust means little if assets aren't properly titled into it. Beneficiary designations are outdated. Trustees are unprepared or ill-equipped. There's no coordination amongst legal, tax, and financial advisors. Another reason to work with financial planners is they talk to my estate planning attorney. They talk to my CPA tax accountant. It all works together. I mentioned trustees are unprepared or ill-equipped. I think naming a member of your direct family to be the trustee is a huge mistake. I've seen it tear families apart in the sense that you nominate your favorite son, but you have 2 or 3 sons and 2 or 3 daughters, or you get the idea. And then favoritism starts to come in, and I've seen people ripped off. I've seen wishes not fulfilled. I've seen people get angry and never talk to each other. It doesn't provide immediate gratification. It can be expensive, estate planning, and it forces uncomfortable conversations about mortality and family dynamics, so it gets delayed. But many estate planning opportunities, particularly those involving tax minimalization or wealth transfer strategies, must be implemented well before death. Once that moment arrives, your options to do it over are gone. Very limited. Estate planning isn't about documents. It's about coordination, communication, and continual maintenance. Another permanent wealth destroyer is taxes. Markets losses are visible, and they're often temporary. Taxes, by contrast, are quieter but permanent. Every dollar lost to inefficient tax planning is a dollar that can't compound. I was able to cut my tax bill almost 80% this year by doing tax efficiency planning with a financial planner team that helps implement the strategy for me because it's beyond me. Tax strategy is often underemphasized in financial planning. Many investors accumulate wealth in tax-deferred accounts like traditional IRAs and 401ks, only to discover later that they've created a future tax problem. Required minimum distributions, RMDs, can push retirees into higher tax brackets. Social Security benefits may become taxable. Medicare premiums can increase due to higher reported income. The result is a cascade of unintended consequences. Lack of tax diversification is a common issue. I see it all the time. Too much in pre-tax accounts, too little in Roth accounts, insufficient taxable, flexible assets. This limits strategic flexibility in retirement. Advanced strategies like Roth conversions, tax loss harvesting, and direct indexing can mitigate some of those risks, but they require proactive planning, often years in advance. The key insight is simple but powerful. Market volatility is uncertain. Taxes are guaranteed. Tax planning isn't a once-a-year activity. It's a lifelong strategy once you hit 50 plus that directly impacts net returns. I have an event coming up. Pints and Portfolio, Sunnyvale, California. April 18th, Saturday, 11:30 to 1:30. Sign up for the event at robblackshow.com.
Don't want to work forever? Check out the Retirement Planning Guide on robblack.com. That's robblack.com, powered by EP Wealth.